Good Saturday morning to you, everybody, and welcome to Mortgage Matters with Rob Weinberg. Rob, I'm Gary Byron. Rob, good morning.
Good morning.
How are you, buddy?
Good. How you doing?
I'm not doing too shabby. I got to tell you, I'm very pleased to see the copy of the book. You've told me about it. You've told us even on the air. I think maybe on our pilot, on our debut, you told me very briefly that you had written a book. It's entitled Mortgage Strategies for the New Millennium, Using Your Home Loan as a Financial Tool, written by the gentleman whose name bears this show here, Rob Weinberg. Wow. It looks fantastic. And from what I understand, you're receiving rave reviews on it.
Yeah, it's gotten really good feedback and 5-star rated on Amazon.
You can purchase this book on Amazon. However, you can also win it. You could actually get yourself a free copy of this book. You know, I say win it. You don't have to answer any questions or anything. In fact, I'll tell you what, at the end of the show, I'll give you all the details on how you can obtain this book absolutely free. When I say free, I mean free. Out the door, shipping and handling, it's all paid for, it's all covered. You're just going to get this book absolutely free. So stay tuned to the end of the show, and I'll give you all the details on how you can claim your free copy. All right, so I think today we're going to talk a little bit about mortgage myths, right?
That's correct.
Let's start off with this. Let's talk about credit first. There's a few different areas that I want to go into, buying a home and refinancing, but let's start with credit. What is the difference between a credit score from, let's say, I don't know, Credit Karma or Credit Sesame, those online credit scores, versus the credit score that a mortgage lender has?
A lot of people think when they get a credit score from their credit card company in the mail or these online sites that that's their credit score. And it's a myth that there's just one credit score. It's unfortunate, but there's a lot of different credit scores and there's multiple credit bureaus. So when you get a credit score from something online or in the mail from your credit card company, that's going to be a consumer credit score. Unfortunately, like I said, it's pretty much worthless. It's just there to make you feel good, and that's really the whole point of it, is just to see if your score is going up or down. I've seen a lot of instances where the credit score you get online or from your credit card company could be 50 points higher or 50 points lower than the score that a mortgage lender is going to get.
How can they get away with that? A score is a score.
That's not the way it is. There's a lot of different versions of the credit score. There's actually 9 different versions of the FICO scoring model. An auto lender is going to have one credit score. A mortgage lender is going to have another. A credit card company is going to have another, because they all weigh different factors. They're all lending you money for different reasons. So you really want to look at the fine print. And I don't think I've had one scenario where someone said, Credit Karma said my score was a 680, and I pull a mortgage credit report and it's 680. It just never happens. I've seen it, like I said, 50 points higher, 20 points higher, 50 points lower, and people get mad, they get disappointed, but it's a myth that there's just one credit score.
Rob, just last night, I kid you not, just last night I'm watching a TV commercial that says if you go to this credit score company's website or app just to check on your credit score, it boosts you 10 to 13 points. And I'm like, why? That's not how credit scores work. In other words, if you've got terrible credit just by going on some credit scores app or website, that it's going to boost your score. That doesn't even seem fair. It doesn't seem right. How can they get away with saying that?
They can create what they want for a credit score. And again, read the fine print. Understand how these companies make money. The way Credit Karma and Credit Sesame make money is by getting you to apply for a loan. Well, if you have a low credit score, you're not going to want to apply for a loan. You're going to be discouraged. But if they can give you a credit score that makes you look better than you think you are, all of a sudden, you're going to click that button. You're going to apply for a mortgage through them. You're going to apply for a credit card through them. That's how they get paid.
But to your point, that's not the credit score that the banks even look at.
It's not, and that's why people get disappointed when they realize that. So if you want a real credit score, you need to talk to a real lender, not an online company or not even the one you get in the mail from the credit card company, but in the context of a mortgage, you need to talk to a mortgage lender. All mortgage companies do use the same scoring model, and it's a FICO scoring model. Again, there's 9 different versions. There's also something called a Vantage credit score, which a lot of these online companies are giving, and that's completely worthless. Not one lender I know of even uses the Vantage score, but they come out and say, oh, we're giving you this new innovative score. But again, nobody's adopted it yet. Maybe 10 years from now they will, but as of now, nobody has. It's all just a marketing.
Doesn't even make sense, right?
It doesn't.
You know,
It doesn't.
good Lord. Typically, how long does it take for credit reports to update, especially when a change is made?
So a huge myth people come to me with is the fact that they think if they paid a credit card off on a Monday, that on Tuesday it's going to show up on their credit report.
Oh.
And that's absolutely incorrect.
Sure.
Most people can realize that there may be some delay, but let's talk about what that is. So specifically when it comes to a credit card, they're going to report the balance on the day after the statement end date. So you want to go to your credit card and you want to look at what is the statement end date. If the statement end date is the 10th, then they're going to report on the 11th. So whenever you make a change, doesn't matter when, they're going to report it once a month on that date. Typically, mortgage lenders report, once a month, depending on the lender. Maybe it's in the beginning or maybe in the middle of the month. But the one people get hung up on is credit cards because they're constantly charging and paying off. And they're really, not known that they're in a situation where it could take up to even 3 or 4 weeks for that to show up on their credit. So the best practice I use with my clients is to either wait the 3 or 4 weeks or look at that statement end date, and that's going to be when it reports.
Should you even pay off your credit card? I was told one time, always have a balance. Even if it's like $40, then go make a purchase, go charge your gas. You hate to say go charge your groceries, but go charge your groceries and then pay it off. In other words, keep a balance. Even if it's low, keep a balance.
There's
Is there
an
truth in that?
argument for that, especially if you're trying to build credit. But in almost all cases, you're going to be best off just looking at it from a strategy standpoint at let me pay this card off. Like you said, you pay it to 0 and charge a tank of gas or, groceries, a pack of gum, whatever it might be to keep it active. But don't feel like I need to keep a few $100s on there. You want, as we've discussed in previous shows, to have 10% of the limit used. So on a $10,000 credit card, you don't want to have more than $1,000 used or they just start dinging you. The lower you can get that utilization ratio, if you can get it to 1% or less, it's going to be good. When I look at people that have the 800 plus credit scores, the A++, one thing they almost all have in common is they have credit cards with very high limits in relation to the balances. So they have either 0 balances or, like you said, $20, $50.
Interesting. See, this is why this is important as we are debunking in talking about mortgage myths, more specifically credit right now. How much impact does a credit inquiry have on a credit score? I was once told that, don't go check your credit score. Why? It's my credit score. How else am I going to know? Well, because if they know, you can only check it like 2 or 3 times every 4 months. Otherwise, it'll lower your credit score. If too many places, too many banks, too many lenders check on an individual's credit score, it could lower the score. I'm like, well, I want to know. So
Let's debunk that myth right now because it is probably the number one credit myth really people have an issue with is inquiry. So first of all, if you check your own credit score, by the way, it's annualcreditreport.com is the free website you can go to actually view your report. You can pay a couple dollars extra to get a credit score from them. But like I said, it may not be the same one a mortgage company is going to use. So when you check your own credit, there's not going to be any sort of hit to your credit score. It's considered a soft inquiry. Same thing when a credit card company you already do business with checks your credit. It's a soft inquiry almost all the time. Where people get caught up is when they apply for a mortgage or they apply for a loan and they get worried, well, I don't want to apply with more than one person because I heard it's going to knock my score down. I've even had people say to me, you checked my credit yesterday and now it went down by 20 points. That's absolutely a myth. Right from the FICO website, they say that a credit inquiry only will reflect your credit score or impact it by 2 to 3 points on average. Now, the lower credit score you have, the more it's going to impact you. The higher credit score you have, the less it's going to impact you. So if you have a 730, 750, 780 score and you go and apply for a mortgage, you may see no change. You may see 2 or 3 points. It's not as dangerous as people say. And the even more important thing about that is multiple lenders, having the credit score pulled by multiple lenders.